Before you get caught up in the excitement of searching for your next home or your next dream home, it only makes sense to find out what you can afford. Joining me today to talk about what you need to know about financing your home purchase is Scott Thomson, a mortgage specialist with Advanced Mortgage and Lending Solutions, or AMLS. Scott, thank you very much for joining me today.
Thanks for having me.
Scott, I'm sure you've heard stories, as have I, about home buyers who've thought that they've had their finances in order, only to find out afterwards that the deal didn't go through, that they made an offer. They had confused pre-qualification with pre-approval. So let's talk about what the differences are.
Okay, so pre-qualification basically is when you sit down with me. So let's say you are looking to buy a home and you want to do an application. So we sit down, we do an application together. Me looking at my all the information I have in front of me, saying, you know what, I think you're good to buy a house at $400,000. That's a pre-qualification.
So it's a rough guesstimate.
It's a rough guesstimate for sure, but a pretty good estimate. And from my years of doing it, that I can say, you know what, everything looks good on my side from what a lender would like to see.
All right.
A pre-approval is very different. So that's when we actually take an application, and certain banks out there will actually do a pre-approval. So you'll send that file in, and the bank looks it over and they go, you know what, we like what we see here. The thing about a pre-approval though is it's not done by CMHC. So if you're putting down less than 20% and it's a high ratio mortgage, the CMHC won't do pre-approvals, so it won't get to that point yet. So it's not technically, 100%. It's just a rough guesstimate also from the lender.
Okay. So we'll talk a little bit about those high ratio mortgages in a bit, but let's talk about some of the benefits to having that pre-approval. Is obviously, as a real estate agent, I know that I'm going to be serving my client better as a buyer because I know that they've already been pre-approved and that they're ready to go out there and buy, and they can act quickly, pull the trigger on a deal when it comes along, submit a purchase offer as soon as they can, and so there's no waiting, there's no that you don't have that financial condition as part of the purchase offer when it comes along. What are some of the other advantages? Well,
absolutely, especially for people that are going to go out and they're searching. It's almost a waste of time to be, if you're looking at a place for $500,000 and you can only afford $4. So why open yourself up to that kind of disappointment when you find that perfect house and you can't buy it anyway? It's just it literally is just a waste of your time more than anything. Getting pre-approved also, you can build that budget early. You know what's going to go along with it. Are you going to have condo fees? Are you going to have all these other things? Having all that stuff kind of
So you've got the expectations already laid out.
Exactly.
And the other thing too is that I found that as a seller might be a little bit more conducive to accepting an offer if they know that you've already been pre-approved.
100%. So sellers definitely, if you're coming to them as a realtor saying, my client would like to put this offer in, they're pre-approved with their bank, compared to someone who hasn't even got financing at all yet.
Right.
The sellers usually will give you a better option, maybe a better time frame for possession dates, all those kind of things. So it's definitely beneficial.
Now, what about when it comes to the self-employed or a commission-based individual? Is it a little more difficult to get a pre-approval for a mortgage?
There's a lot more to it when they get qualified, for sure. It's not any harder to get pre-approved. It's just we look at a whole bunch of different things on their income side of things to get them to that point.
All right. So getting pre-approved is going to help the buyer have a better understanding of all the costs in getting a home purchase. So there's going to be no surprises when it comes time to pay. So you'll be better prepared to know how to manage your money, including knowing those monthly payment amounts.
Exactly.
And that is so critical, isn't it? So before we talk about down payments, let's talk a little bit about what goes into determining that monthly amount.
Okay, so when you get qualified, there's two numbers that we work off of. Your GDS and your TDS. So your GDS is your gross debt service and your TDS is your total debt service. So when you get qualified, everything really depends on your income and your credit. So if you have good credit and you're not carrying a lot of debt, it's easier to get you qualified for sure. Your income basically is what your GDS is based off of. So your TDS would be all your income plus your debt. And that's where your TDS rolls into. So if you have good credit, a 39% GDS and a 44% TDS is kind of the max numbers that you want to play with.
Okay? All right. And so when we're talking credit, again, there's Equifax has been in the news lately.
For sure.
For a little bit of a hack, but they're still one of the well, the big three in Canada when it comes time to getting a credit report.
For sure, and I was talking to people yesterday. A lot of the younger people don't even realize they have a credit score, which is a little terrifying at times.
Right.
But it's super important to know what your credit report looks like. What your score looks like. If you're having any problems on there, most people don't realize they might have missed a phone bill 3 years ago, and that's affecting their credit score. By 3 days, like you don't know even. You have no idea that it affected you. A good credit score is about 650 for lenders, and over 700, they really like a score over 700, and that will get you better options with lenders.
All right. So when it comes time to getting a mortgage now, there are different kinds of mortgages available. We've got the conventional mortgage. We've talked about that, which is primarily you're putting a down payment of up to 20%. So your mortgage then is up to 80%.
Right.
Anything more than 80% is considered a high ratio mortgage.
You're getting the high ratio. So
some different rules.
Yeah, well, you're basically going to be paying CMHC default insurance. So basically, it's mortgage default insurance.
Right.
So depending on if you put down 5, 10, 15%, there's a different percentage for all of those, up into 20% where you would pay none. The other thing too, with the recent federal government changes, if you're putting down less than 20%, you're now subject to the 4.84% stress test. So it's making it a little bit harder for new buyers to get in and buy something. If they thought they were buying something for $400,000, now they're kind of in that 320 range.
So it does make a big difference.
It makes a
on
huge
what they
difference.
Can afford.
And that's the other thing too. People, before the changes, they may have had friends that bought and said, yeah, I bought a $400,000 house. We make the same amount of money. Nowadays, after these stress tests, they're going to find out that they can only find something for 320 instead of what their friends bought for 4.
Very important to do the work ahead of time to find out what their mortgage payment is going to be, how much they can afford to put down. And I want to again talk a little bit about that down payment in a second, but let's wrap up on the interest rate part of things. You've got variable rate and fixed rate mortgages.
For sure.
In this day and age when mortgage rates are really at historic lows, what are the advantages or disadvantages for going for each kind of mortgage, variable or fixed?
Well, that really depends on the client themselves. A 5-year fix at these low rates right now is pretty much a given. It's a really good thing to lock into. Variable rates have been better for the last 30 years, and that's graphically a fact. But right now with the rate changes we've already had 2 this year. It's rumored we're going to have another one this year, possibly another one in the new year. Variable rates are going to climb fast. So getting into a nice low locked 5-year fix right now is probably a good thing. If you're moving in 2 years, or rentals, I like to tell all my clients, if you have a rental, variables are a good option because you're going to pay less of a payout penalty if you have to leave that mortgage sooner. Okay, so payout penalties are different if you're on a fixed or on a variable. So a variable, you're looking at 3 months interest only, and on a fixed, you're looking at 3 months interest or interest rate differential, which is a different calculation they do. Whatever's higher is what you're going to pay. So if you get into the rental business and you want to get rid of that rental after 2 years, you just don't want to be a landlord anymore. You don't want to give up the farm by paying a payout penalty.
Sure.
Might as well just stay with the variable, because the difference in what you're paying is not going to be massive. So.
Okay.
But again, it really comes down to the client and discussing with myself to say, this I think is your best option, and I think this would be a better rate to go with at the time.
Who do you get your mortgages from? Who does a buyer get mortgages from? Traditionally, it's been banks,
Yep.
but there are other sources of income in Canada as well.
So we've got about 40 or 50 lenders we work with, from A side, B side, private side. Basically, there's 2 kinds of banks out there people don't even know about. So you have your A banks, your Schedule A banks, your TDs, your BMO, your Scotia banks. There's also banks out there called monoline banks, and people really don't know what that means. So there's Street Capital, First National, CMLS. People have no idea who these banks are, but they're the kind of banks, they're called monolines only because they do one thing. They just do mortgages. But they're the same as a TD. They're still A banks across the board, and usually you can get a better rate because they don't have any storefronts to cover on all the overhead that a TD would have. Sure. Or a BMO would have. So you can usually get better rates at a monoline.
All right. And mortgage broker's job is really to find the best rate the best mortgage for their client from all of the options that are out there?
100%. So the first thing, everybody comes to me and they say, what's the best rate available? And I say, well, hold on, let's get you qualified first, and then let's see where you kind of slot in. With our ability to go to 40 or 50 banks, we really are not going to get beat on rates. Like it's rare that I would get beat on a rate, but finding the options and what a client's looking for their particular situation, maybe they're living here for 2 years and they're going to be moving, and they know that their job is moving them to
Sure.
another city in Calgary, or in Canada, sorry. So maybe a 2-year mortgage is what's going to fit for them. So then obviously we're going to go and we're going to look for 2-year mortgages, or we're going to go look for a variable mortgage, something to get them in and out quickly. Okay. So it really comes down to what the client needs compared to just the rate all the time. So.
All right. Now, I've talked a little bit about it. We've hinted at it, the down payment. And again, the more down payment that you can put down is better for your financial situation usually.
Yep.
Mortgage, you get the different rates. You get qualified at that high ratio or the conventional mortgage. But for a person who is just starting out, you can get that high ratio mortgage with just 5% down, is that right?
That's correct. And let's say you've got some RSPs. So as a first-time home buyer, you can pull RSPs out of there up to $25,000.
Well, that's good to know.
You can
gift money?
Gifted from your parents for sure, or a family member. It
now,
can't
all
be
this
from
has
your
to
friend.
be declared though.
All of it has to be declared. We have gift letters we would give them to sign. That money gets put into their account and we track it that way. Or just pure savings. They can save it up, or maybe it was something that your grandparents left them years ago. It's been in their account forever, and they can use that as well.
And that's the biggest complaint that we hear from a lot of younger Canadians especially, is that a majority of them are having a hard time saving up for that down payment. But again, it is so crucial because you don't want to be house poor.
For sure, 100%. So obviously, the more you put down, the less money your payments are. So I go back to that GDS, TDS number. When you're at 39 and 44, that's the max that they're going to allow you to go. You can't go over that number. If you're at those numbers, you're not technically house poor, but you're kind of putting yourself in that range where
you're
a lot of your
money. Tough time if an emergency comes up.
Exactly.
You're going to be hooped.
Yeah, because all your money, that highest percentage is going to that. So we like to have people in that 36, 39 range. That would be a nice number to be at.
All right. Scott, thank you very much. Scott Thomson from AMLS, Advanced Mortgage and Lending Solutions. If you're thinking about buying a home, do your homework. Talk to your mortgage lender or your mortgage broker first to avoid disappointment later.